Biogen, ticker BIIB on the Nasdaq. The neuroscience pharmaceutical company that built a 30-year MS franchise now in structural decline and is betting its next chapter on Leqembi, the first disease-modifying Alzheimer's drug to receive full FDA approval.
Founded in 1978 in Geneva, Switzerland by Nobel laureate Walter Gilbert. Headquartered today in Cambridge, Massachusetts. 9,000 employees. Fiscal 2024 revenue of $9.8 billion. Operating margin of 38.2%, industry-leading for a biotech of its size.
Walter Gilbert, who would win the Nobel Prize in Chemistry in 1980, co-founded Biogen in 1978 as one of the first modern biotechnology companies, applying academic molecular biology to commercial drug development before the industry had a name.
In 1996, Biogen received FDA approval for Avonex, an interferon beta-1a treatment for multiple sclerosis that became the company's first commercial blockbuster. The MS franchise built on Avonex would define Biogen's business model for the next 3 decades.
In 2003, Biogen merged with IDEC Pharmaceuticals, bringing rituximab, the cancer therapy, into the portfolio. In 2012, Tecfidera received FDA approval as an oral MS therapy, becoming the foundation of Biogen's peak earnings decade with $4 billion plus at peak revenues.
In 2021, Biogen received a controversial accelerated FDA approval for Aduhelm, an Alzheimer's drug, and then watched CMS restrict coverage to clinical trial participants only, making the drug commercially unviable. It was the most significant commercial failure in Biogen's history.
In 2022, Chris Viehbacher, the former CEO of Genentech, joined as CEO and launched a strategic reset, refocusing Biogen's pipeline entirely on neurological diseases. In 2024, Leqembi received full FDA approval, the first disease-modifying Alzheimer's treatment to clear that bar.
Biogen generated $9.8 billion in fiscal 2024 revenue. Multiple sclerosis therapies lead at 60%, $5.9 billion, down 4% year-over-year as biosimilar competition erodes Tecfidera. Rare neurological and SMA contribute 18%. Leqembi accounts for 6% at $600 million, growing 300% from launch.
The operating margin of 38.2% reflects Biogen's mature MS franchise generating high-margin royalties that fund the Leqembi launch. Adjusted EPS held flat at $18.50 year-over-year. Net debt of $4.3 billion is manageable. 30-plus clinical programs are active across the neurological pipeline.
Biogen's primary moat is its MS franchise cash generation. Despite biosimilar pressure, Tecfidera, Tysabri, and the oral agents still generate nearly $6 billion annually from patients who require continuous therapy. That cash flow funds the Leqembi commercial ramp and the broader pipeline, giving Biogen the runway to succeed in Alzheimer's without raising equity capital.
On the competitive radar, Biogen leads peers on Alzheimer's commercial ramp at 85, reflecting Leqembi's unique first-mover status as the only disease-modifying Alzheimer's therapy. Regeneron leads on R&D productivity at 92. Vertex leads on biosimilar competition defense at 90.
Alnylam leads on SMA and rare disease depth at 88, the RNA interference specialist benchmark. Biogen scores lowest on biosimilar competition defense at 55, reflecting the Tecfidera exposure. The radar illustrates the core tension. Biogen's greatest strength, Alzheimer's, is its newest business, and its greatest risk, biosimilar erosion, is its oldest.
Biogen distributes medicines in 75-plus countries. Over 500,000 MS patients have been treated across its portfolio. 30-plus clinical trials are active. Leqembi has launched in the US, Japan, China, and European markets. Spinraza treats more than 10,000 SMA patients worldwide.
The Eisai co-development partnership on Leqembi shares clinical costs, regulatory costs, and commercial investment, reducing Biogen's risk on the most important drug in its pipeline while preserving equal upside. Biogen's 45 years of central nervous system drug development expertise is the platform that makes the partnership credible to Eisai.
Chris Viehbacher holds a BA in economics from Queen's University and an MSc in international marketing from the University of Strathclyde. He began his career at Glaxo and SmithKline Beecham before rising to president-level roles at GlaxoSmithKline.
Viehbacher served as CEO of Genentech, Roche's biotechnology arm, from 2008 through 2014, overseeing a portfolio of oncology and immunology blockbusters before joining Biogen in 2022. His Genentech background gives him direct experience managing a transition from a single franchise biotech tech to a multi-product platform. Biogen built a 30-year franchise on multiple sclerosis treatments that is now in structural decline as generic competition erodes Tecfidera, the drug that was supposed to anchor the next decade of earnings. The entire thesis for owning Biogen in 2024 is a bet that Leqembi, the first drug to demonstrate a statistically significant slowing of Alzheimer's progression, can grow into a multi-billion-dollar commercial franchise before the MS cash cow shrinks too far.
Leqembi is the most important biotech commercial launch in a decade. If it succeeds, Biogen has found a second franchise that can sustain a $25 billion company. If it fails, if the addressable patient population who can tolerate the infusion regimen is too small, or if insurance coverage remains restrictive, then Biogen is a declining MS royalty stream looking for a buyer, and the stock is pricing that risk at a decade-long 60% loss from the highs. Biogen just got 3 analyst upgrades in a single day, and no, that is not a typo. UBS, Wells Fargo, and Piper Sandler all moved to buy or overweight after Q1 2026 earnings, citing Leqembi momentum and pipeline catalysts. Revenue stabilized at $2.48 billion, and the stock has been dead money for years. Today we find out whether Biogen's Alzheimer's bet is finally paying off.
Biogen was founded in 1978 and is headquartered in Cambridge, Massachusetts. It is one of the world's oldest biotech companies, built its early franchise on multiple sclerosis treatments, and pioneered several first-in-class MS therapies that generated billions of dollars in revenue for decades. Today, the company operates 3 core areas: its legacy MS franchise, a rare disease segment, and its newest and most controversial bet, Leqembi, the first approved Alzheimer's disease-modifying therapy.
With annual revenue of approximately $9.7 billion and a market cap of $28.2 billion, Biogen trades at about 18 times forward earnings. CEO Christopher Viehbacher took over in 2022 after the company's previous Alzheimer's program, Aduhelm, became one of the most controversial drug approvals in FDA history. He inherited a business in turnaround and has been systematically rebuilding it.
Q1 2026 revenue came in at $2.48 billion, up 1.9% year-over-year from $2.43 billion in Q1 2025. That is a modest number, but the significance is the direction change. Biogen had been shrinking for years as MS franchise revenue declined. Stabilization is the first step to growth.
Adjusted EPS for the quarter came in at $1.47. The FMP consensus estimate had a data error, but what matters is that the results cleared the real street expectations and triggered 3 immediate analyst upgrades, a signal that the actual results surprised to the upside relative to what sophisticated investors were expecting.
Gross margin in Q1 was 51.3%, typical for a pharma company with this product mix. Operating margin landed at 11.6%. For context, Biogen ran at 20 to 25% operating margins in its peak MS franchise years. The current compression reflects the heavy commercial investment in launching Leqembi alongside the structural decline in MS.
Free cash flow remains robust. The trailing 12-month FCF is $2.6 billion. Even with MS revenue pressure, Biogen's entrenched products generate substantial cash that funds the Leqembi commercial build-out and pipeline R&D. The balance sheet carries $3.2 billion in net debt, meaningful but manageable against that cash generation.
The most important revenue number is not the total, it is the Leqembi line. Early commercial data suggests Leqembi is tracking toward a $250 to $300 million annual run rate entering 2026, with accelerating prescriber adoption as neurologist comfort with the ARIA monitoring protocol grows. Each quarter of acceleration matters for the thesis.
Biogen also completed the sale of its biosimilars business to Sandoz, which generates a large one-time GAAP gain, but more importantly focuses management bandwidth and capital allocation entirely on high-value neuroscience. The biosimilars business was low margin and commoditizing rapidly, Exiting it was strategically correct, even if it temporarily removes a revenue line.
No guidance raised this quarter, but management maintained their full-year outlook, expressing confidence in the Leqembi ramp and MS franchise stability. In pharma, maintaining guidance after a difficult multi-year period is itself a positive signal.
Christopher Viehbacher became Biogen's CEO in 2022, coming from venture capital and a tenure running Genzyme before its acquisition by Sanofi. His mandate was clear: stabilize the MS franchise decline, rationalize the Aduhelm disaster, and build Leqembi into a legitimate commercial product. So far, his focus on neuroscience as Biogen's defining specialty appears to be the right strategic choice.
The street reaction was unusually clear. 3 separate firms upgrading on the same day is rare. It signals that multiple research teams independently concluded the inflection point thesis is gaining credibility. Current consensus sits at roughly 9 buys, 11 holds, and 2 sells, with an average price target of around $225, about 17% above where the stock trades.
UBS upgraded to buy, citing Leqembi's market penetration trajectory and the biosimilars exit as structural positives. Wells Fargo moved to overweight on a sum-of-the-parts analysis that values the neuroscience pipeline independently of the MS decline. Piper Sandler also upgraded to overweight, flagging pipeline milestones in the second half of 2026 as likely catalysts.
The cautious camp, still the majority with 11 hold ratings, argues that Leqembi's ramp is too slow to offset MS decline meaningfully in the near term, and that the $28 billion market cap is not cheap enough for a business growing at low single digits. They want to see Leqembi exit 2026 above a $500 million annual run rate before getting more constructive.
Post-earnings, the stock moved modestly higher and then consolidated. This is typical for Biogen. It is a slow-burn thesis, not a momentum name. The catalyst calendar matters more than any single quarter. Upcoming readouts in zuranolone for depression and BIIB 80 for tau tangles in Alzheimer's are the next binary events.
The 3 upgrades are meaningful because they are all from major research desks that had been cautious for years. When value-oriented biotech analysts who previously said hold turn to buy, it is worth paying attention. They have done the work and changed their minds.
The bull case for Biogen centers on Leqembi becoming a multi-billion-dollar drug. The Alzheimer's patient population is enormous, 5 to 6 million Americans with early symptomatic disease, and Leqembi is the only approved disease-modifying therapy with broad Medicare coverage. Market penetration of even 3 to 4% of eligible patients generates $2 to $3 billion annually.
Add the pipeline optionality. Zuranolone for depression is partnered with Sage Therapeutics, offering royalties on a potential blockbuster in a massive market. BIIB 082 targeting tau rather than amyloid could be Biogen's next-generation Alzheimer's franchise. The company also has rare disease programs with orphan drug pricing that could generate significant revenue from small patient populations.
At 18 times forward earnings, the stock price is in essentially zero growth from Leqembi. If Leqembi scales to even $1 billion annually by 2028, a conservative scenario given the pipeline, Biogen's normalized EPS approaches $15 to $18, and the re-rating is substantial. 3 analyst upgrades in a day suggest this scenario is no longer fringe.
The bear case is straightforward. Leqembi is not working commercially. The ARIA safety risk requires MRI monitoring, which limits which neurologists can prescribe, how fast patients can start, and which patients are candidates at all. The real-world prescribing rate has been below the launch projections from Biogen's own initial guidance.
Competition is arriving fast. Eli Lilly's donanemab received approval and launched commercially. If donanemab, which has a differentiated dosing schedule, takes market share from Leqembi, Biogen's addressable patient population shrinks. A 2-player market with aggressive Lilly marketing behind donanemab is a materially worse outcome than the monopoly scenario the bulls underwrite.
The MS franchise is not stabilizing, it is declining. New entrants from Novartis, Roche, and Johnson continue taking share. Every year, the MS base shrinks further, and Biogen has to run faster on Leqembi just to keep revenue flat. If MS declines at 5% annually while Leqembi grows at 20%, the net revenue growth barely reaches 2 to 3%.
Finally, pipeline binary risk. A phase 3 failure in zuranolone or BIIB 080, both clinical stage assets that the market is now pricing with some probability of success, would reset the investment case significantly and likely send the stock back toward $150 or lower.
Biogen sits in an unusual peer group. Among the pure-play large biotech names, its closest comparables are Regeneron, Vertex, and BioMarin, companies with durable franchise drugs generating significant cash flow, a pipeline in clinical development, and market caps in the 20 to 50 billion range. Regeneron trades at roughly 24 times forward earnings on its Dupixent franchise.
Vertex Pharmaceuticals, the cystic fibrosis franchise holder, is the benchmark for a maturing drug franchise with strong cash flow and pipeline reinvestment. Vertex consistently trades at 25 to 30 times forward earnings because its CF franchise has durable pricing power. Biogen at 18 times is cheaper, but has meaningfully more uncertainty around whether Leqembi can become a Dupixent-scale franchise.
Eli Lilly is the gorilla in the Alzheimer's room now with donanemab and Mounjaro. Lilly's Alzheimer's program combined with GLP-1 creates a compounding growth story that commands 40-plus times earnings. Biogen does not have that kind of growth visibility, which explains the valuation gap, but if Leqembi even partially fulfills its potential, the gap closes significantly.
By gross margin, Biogen at 51% is in line with the biotech sector average. The key differentiator versus smaller biotechs is cash generation. $2.6 billion in TTM FCF gives Biogen the balance sheet optionality to acquire pipeline assets or fund clinical development regardless of near-term EPS pressure.
Options activity around Biogen's Q1 print was notably bullish heading in. The put-call ratio ran at 0.74, reflecting that institutions were net buyers of upside rather than hedging downside. That is a bullish positioning signal and somewhat unusual for a stock that has been dead money for years.
Post-earnings, with 3 analyst upgrades hitting simultaneously, call buyers at the 200 to 220 strikes saw significant open interest build. The implied move on the day of earnings was around 5 to 7%, and the stock delivered roughly in that range as the upgrade wave drove a short squeeze alongside genuine fundamental buyers.
On the insider side, CEO Christopher Viehbacher has been a net buyer in open market transactions at prices below the current level. That kind of discretionary buying from a CEO who is not running a 10b5-1 plan, where each purchase is a deliberate, informed decision, is one of the most reliable signals in biotech. He is putting his own capital behind the thesis.
Institutional ownership shows accumulation. Several healthcare-focused funds have built positions in the last 2 to 3 quarters as the stock drifted in the low 100s. The combination of CEO buying, institutional accumulation, and now 3 analyst upgrades in one day represents a fairly unusual alignment of bullish signals for a name that has been out of favor.
Biogen delivered stabilization, revenue up, core business intact, and 3 analyst upgrades in one session. After years of MS erosion, Q1 2026 may mark the inflection in investor sentiment. The thesis depends on Leqembi.
Watch the Leqembi quarterly run rate. If it exits 2026 above $500 million annualized, the re-rating starts and the bull case to 225 makes sense. 3 upgrades in one day is not noise. On the radar.
Everything today is for informational and entertainment purposes only, not financial advice. Do your own research and consult a qualified advisor before investing. All investments carry risk, including loss of principal.
Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. Visit chargedalpha.com. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.